This is not investment advice. This is the structural deconstruction of a broken system. Wall Street algorithms are attempting a very dangerous game. They are trying to convert a paper employment recession into an easy liquidity trade. They are trying to buy the dip on negative 92,000 jobs. They are wrong. Crude oil and the physical pricing of Treasury yields are locking the Federal Reserve into a stagflation death trap. A trap they cannot escape. Look at the Bureau of Labor Statistics data. The February non-farm payrolls dropped by 92,000. The unemployment rate hit 4.4%. In a normal cycle, that is the trigger. The machines read the headline. The algorithms buy equities. They expect the central bank to panic. They expect rates to fall. That is the old playbook. But at the exact moment the paper employment data collapsed, the long-term bond market refused to play along. The 10-year Treasury yield did not drop as Wall Street expected. It hard bounced. It rose from 3.97% on February 27th to 4.13% on March 5th. Read that divergence carefully. The capital markets are now fighting a very cold reality. Weak employment no longer equals cheap liquidity. The algorithm is broken. The bond vigilantes are awake. We mapped this exact sequence out. We identified the vulnerability in the soft landing narrative weeks ago. We locked onto the data revision game. The latest reports simply confirm the decay we already measured. The Bureau of Labor Statistics does not just report current numbers. They rewrite history. December 2025 was quietly revised down by 17,000 jobs. January 2026 was revised down to a mere 126,000 additions. Across 2 months, 69,000 paper jobs evaporated from the official record. They never existed. They were statistical artifacts. The safety margin for a macroeconomic soft landing is getting razor thin. Yet, the mainstream financial media refuses to formally confirm the recession narrative. They are waiting for permission. The data does not wait. Look at the physical response. The Middle East conflict escalated. Crude oil pushed to highs not seen since 2023. That direct energy shock pulled the S&P 500 and the Nasdaq lower immediately. The pricing mechanism of hard, physical assets front-ran the weakness in the paper employment data. The physical market locked in the inflation premium before the Bureau of Labor Statistics even published the payroll miss. When real assets diverge from paper narratives, the paper always loses. The tape does not lie. The revisions prove the weakness was always there. The structural integrity of the labor market is failing. You have to tear the non-farm payroll report apart. You have to strip away the noise and locate the structural fault lines. On the surface, the healthcare sector lost 28,000 jobs. The mainstream will dismiss this. They will call it a short-term distortion driven by doctor office strikes. They will tell you to ignore it. Do not look at the surface. Look at the deep structure. Look at the federal government employment baseline. Federal government jobs have plummeted by 330,000 since their peak in October 2024. That is not a strike. That is a structural purge. That is a contraction in the administrative foundation of the labor market. Then look at the duration of the damage. The number of long-term unemployed individuals just hit 1.9 million. That cohort now represents 25.3% of the entire unemployed population. Compare that to 1 year ago. The number was 1.5 million. The permanent scarring of the labor force is accelerating. People are not just losing jobs. They are failing to re-enter the system. But here is the core fracture. This is the data bomb that destroys the Wall Street consensus. The absolute number of jobs is contracting. The labor market is objectively weakening. Yet, average hourly earnings are still rising. They increased 0.4% month over month. They are up 3.8% year-over-year wage. Stickiness is entrenched. You have a shrinking labor pool demanding higher nominal compensation to survive physical inflation. This is the textbook definition of a stagflationary labor environment. Now overlay the official inflation metrics. The January overall consumer price index rose 2.4% year-over-year. Core CPI rose 2.5%. The personal consumption expenditures index, the metric the Federal Reserve supposedly worships, tells the same story. The December 2025 overall PCE printed at 2.9%. Core PCE printed at 3.0%. Both core inflation metrics are rigidly stuck above the central bank mandate. This is the nightmare scenario. A weakening underlying economy colliding with persistent, high inflation pressure. It is the exact combination the market fears most. Why? Because the Federal Reserve does not possess a single, perfect monetary tool to solve both problems simultaneously. If they cut rates to save the labor market, they ignite the inflation embers. If they hold rates to crush inflation, they accelerate the employment collapse. The dual mandate has become a suicide pact. The informed capital recognizes this. The Eastern Bloc and the physical commodity markets saw through this dilemma months ago. That is exactly why the short end of the sovereign curve is misbehaving. The 2-year Treasury yield did not collapse on the weak payroll print. It rose. It moved from 3.38% to 3.57%. A weak jobs report should crush the 2-year yield. It should signal immediate rate cuts. It did the opposite. The market is synchronously pricing in price risk and risk premium. Capital is demanding higher compensation to hold short-term United States debt because the inflation risk is overriding the employment risk. The bond market is mathematically rejecting the Federal Reserve forward guidance. Eastern buyers understand the difference between paper yields and physical purchasing power. When you see yields rising into a contracting labor print, you are witnessing the death of the Phillips curve in real time. The models are broken. The physical market is taking control. The baseline narrative of the Federal Reserve is actively disintegrating. We are watching a slow-motion institutional failure. Look at their official communications. Strip away the academic phrasing and look at the raw contradiction. Following the January 28 FOMC meeting, the official statement claimed the United States economy was expanding at a solid pace. Jerome Powell stood at the podium on January 28 and insisted the economy was standing on a solid footing. John Williams echoed this on March 3. He categorized the economy as overall in a good place. They project absolute control. They project stability. It is a calculated facade. The internal fractures inside the Eccles building have existed for weeks. Michelle Bowman spoke on January 30. She did not use the approved script. She explicitly warned that the labor market is vulnerable beneath the surface. Christopher Waller broke ranks on February 23. He admitted his justification for supporting a rate cut in January was the increasing downside risk to employment. They knew. The data model showed the rot before the February print confirmed it. The February non-farm payroll report permanently shattered the illusion of a stable labor market. It validated Bowman. It validated Waller. It destroyed Powell baseline assurance. Simultaneously, the inflation metrics remained stubbornly distanced from the 2% target. The Federal Reserve is trapped between governors terrified of a hard landing and governors terrified of structural inflation. This February data print will amplify their internal division infinitely. There is no consensus. There is only institutional paralysis. This brings us to the most critical failure point in modern market mechanics. For the last 15 years, Wall Street relied on a single, binary logic loop. Weak economic data triggers central bank panic. Central bank panic triggers liquidity injections. Liquidity injections drive equity valuations higher. Bad news was mechanically translated into good news. That logic loop is dead. The recent, aggressive upward moves in crude oil and Treasury yields have completely severed Wall Street's most dependable trade. The automatic assumption that weak jobs equal an immediate dovish pivot is finished. You cannot inject liquidity into a system where the bond market is already demanding a higher term premium for inflation risk. The Federal Reserve has lost control of the long end of the curve. When the 10-year yield races against a negative 92,000 jobs print, the central bank is paralyzed. They cannot cut rates without risking a sovereign bond strike. The matrix of the soft landing is decoded. It was always a mathematical impossibility, disguised as forward guidance. The algorithm bought the dip. The algorithm is trapped. This channel is built on objective reality. We do not marry a thesis. We test it against the data. A stagflationary framework is the highest probability outcome, but it is not immune to variables. We must map the invalidation points. There are 3 specific macroeconomic variables that could dismantle the stagflation narrative. Variable 1. The structural decay might just be short-term statistical noise. The February non-farm payroll data included population estimate updates. It included the localized effects of a doctor office strike. It included severe weather anomalies. If the Bureau of Labor Statistics aggressively revises these numbers higher in the coming months and smooths out the noise, the thesis of a collapsing labor structure must be entirely re-evaluated. Variable 2. Gross domestic product resilience. Absolute economic contraction is not yet visible in the top-line output. The Atlanta Fed GDP Now model is a real-time tracker. As of March 6, that model is still forecasting a 2.1% real GDP growth rate for the first quarter of 2026. An absolute, technical recession has not officially begun. If output holds, the hard landing is delayed. Variable 3. Geopolitical de-escalation. The inflation anchor right now is crude oil. If the situation in the Middle East suddenly stabilizes, the geopolitical risk premium in energy markets will collapse. Oil prices will drop. That removes the immediate front-end inflation pressure. A drop in energy costs would widen the Federal Reserve policy window. They would gain the exact operational space they need to cut rates without immediately triggering the bond vigilantes. Track these variables. Do not ignore data that contradicts your positioning. Intellectual honesty is the only defense mechanism you have in a heavily manipulated tape. The February non-farm payroll report is not the final verdict. It is merely the starting line for the next verification window. The pressure is compounding. For the immediate trading cycle, abandon your focus on headline employment figures. The headline is compromised. Lock your screens onto the Fed 10-year break-even inflation rate. Do not look away from it. This is the sharpest, most ruthless indicator of true market-based inflation expectations. The break-even rate will tell you what the bond market actually believes, regardless of what the Federal Reserve says. Mark your calendars for the incoming data strikes. March 11th, the February Consumer Price Index drops. March 13th, the Personal Income and Outlays Report hits the tape. This includes the highly critical January PCE data. These two specific data sets are the terminal triggers. They will entirely dictate the Federal Reserve baseline script for the March 17th to 18th FOMC meeting. These prints will force the central bank to make a choice. They will either continue defending a broken soft landing narrative, or they will completely capitulate to the stagflation reality. The algorithms are blind to the physical trap. The bond market is not. Verify the data yourself. Read the tape.